All right. Hey there, everybody. Good morning, good afternoon, good evening, depending on where you guys are at. I hope y'all are having a good trading day so far. There we go. Hey, Mirza, Polly, great to see y'all. Certainly, it is. I hate to say it, but it is a choppy day again today. So let's start with SPX. We'll go on from there. If you guys have any questions around trading whatsoever, this is the perfect room to ask it in. We can really spend time diving into some answers, hopefully give you guys some clarity on whatever questions you have. If there's a symbol that you want to look at or anything like that, feel free to let me know. I am happy to pull it up and we can discuss it. But let's start with the market, of course, and then we'll go on from there. Hey, CG, good to see you. Hope you're doing well. So, starting with SPX this morning, we gapped lower. Now, there were a few clues that this could happen. Though I personally was a little cautious to take them, so I won't pretend like I did or anything like that. But there were a few clues that we could move lower. The first one came into the closing bar on the hourly chart yesterday. We made a bearish divergent bar. Now, my hesitation about taking a move lower based off that was because yesterday we literally had back-to-back divergent bars for every bar that printed that day. And for those of you who are maybe signed up for the options open house, uh, I mentioned at the start of my session in there that that was a good sign that we could start to chop. And I certainly wouldn't anticipate a break above the high. And we really didn't even get above the high. 4160 was kind of the next target. I had 4150 being a psychological level. And you can see that's right where we ended up trading in between those two ranges and certainly into the close yesterday. Yesterday never broke the 10-period simple, which was a good sign that support was trying to hold. That, was part of the hesitation of taking the bearish trade here. Um, but we have found trading this divergent bar indicator that on SPX in particular, if you have a valid bar into the close, it's not uncommon for it to follow through at some point the next trading day. And so you can see here we had a valid bearish divergent bar into the close, and that followed through with a gap down the next morning. We actually went down, tested the 30. That so far is holding us support, bullish divergent bar, bounced up, but now we can't break above the 10. The 10, which was doing so well as holding support yesterday, has now turned into a resistance level that currently the price is kind of struggling to get above. And it's at 4148.95. That's right by 4150 as a psychological level. So might be a little tough to get through. Um, Momentum is in the process of resetting. We have a pullback signal. Bollinger Bands are in consolidation. On our smaller time frames, the 5-minute chart, I'll say, looks a little bit weaker just because we're rolling down off our moving averages. If we do continue lower, the 10-period simple, which is this short dash line, will cross back below the 30. That will start to make a stack down bearish formation. And that could lead to a little bit more selling. However, we're at the 100-period simple on the 10-minute chart as support. So if we don't break this level, right, and these Bollinger Bands on the 5-minute chart don't start to flare open, then we may very well just be stuck in chop, at least for the morning, if not maybe overall for the day, which has really been the narrative we have seen recently in the market. Had a slow grind to the upside, right? The price on the daily chart for SPX has done a really good job of holding the 10-period simple here, but you can see that we've barely followed through with higher highs, and then we pull back, or we stay mainly trading in the range that we were in the prior trading day. So as much as we like to see the more directional moves that we had last year, whether they're up or down, we're just not quite getting that this year. And in particular, more recently. And there are a few reasons for that. One, right, is because overall, the bigger range of things on SPX for this year is consolidation at this point. 3,800 has been acting as a price support level, and just slightly below 4,200 has been price resistance. And there's a reason for that. When we go to the weekly chart, you will see that we have weekly resistance right above us at starting around 4203 last I checked with the 100 period simple, and of course 4200 is a psychological level. But then all the way up into 4260 with the ATR trailing stop. So we have a few different levels here acting as resistance. The weekly bar, depending on how we go into the close this week, which obviously it's Wednesday, so we still have half the week left in order to trade. But currently, it's trying to make a bearish divergent bar off this level. And Bollinger Bands, which we're starting to open up, if we do make that bearish divergent bar and stall or pull back, will very likely flatten back out, much like they did here, where basically they made room for the price to go up and test resistance, but they're not anticipating a break of it. If we can manage to break it, then that could be a good clue that the weekly squeeze could start to fire and maybe finally get us back into a bullish trend, which I'm sure a lot of us would be more than happy to see. But at this point, unfortunately, CHOP still looks like it has a hold on this market, or at least it is causing some struggle here for bulls to really try and get up and get going. So we'll definitely be curious to see how this weekly bar goes into the close on Friday, whether or not it prints. And if it does, right, could be a clue to be a little bit more mindful of the bullish trades, at least shorter term, unless you're in a honey badger type symbol that's doing what it wants. Um, and to look more at consolidating trade ideas or even maybe some more bearish trade ideas that benefit from theta decay, things like call credit spreads and call unbalanced butterflies. Well, Alberto, welcome. Glad to have you aboard here. We certainly have a good time. So, um, Dave is asking, is it easy to calculate SPX PM cash settlement? It is. Um, I'm guessing you're just meaning when you say the PM, the weekly expiration, and if or the daily expiration, right? And so, unless it's the monthly expiration, that one can be a little bit trickier to calculate because it goes off all the different companies' opens and then does the calculation off that. But for every other trading expiration on SPX into the close, it's literally where the market closes. So yesterday, for example, SPX closed at 41.5487. So if you had any sort of pin trade around 41.55, you probably were having a very happy day into the close. But it's literally off the closing price of SPX. The only one that can be slightly different typically is that monthly AM expiration, where it does the whole calculation based off all the opening companies, how much weight they have in SPX. And then that calculation can sometimes be slightly different to where just SPX in general opens for the day. So I hope that it answers your questions there, Dave. And then CG, excuse me, is asking, just curious, I heard a professor project price action chop since January. What clues could give us this insight 4 months ago? Great question. So let's take a look. Um, I think it will be a bit clearer on a weekly chart. So let's go back to that because there are a couple clues. And it's something I've been trying to be mindful of myself because this so far how this year is turning out is reminding me very much of 2015, 2016 for any of you guys who traded back then, where we didn't really quite a pullback in the market like we saw last year, for example, but we never got going in the market either. It just remained choppy. So what were some of our clues that we could go into consolidation? Well, on the weekly time frame, our moving averages were in consolidation at the start of the year, right? The 10 period simple is in between the 30 and 100. So that's already a clue of consolidation. One of the other clues is the Bollinger Bands. Now, they did start to open up a little bit here, but for anyone who is following along with me, I even mentioned to y'all be very mindful that even though these are opening up, it could just be that they're opening up to make room for the underlying price to be able to test resistance and stay within the comfort zones. For those of you who are unfamiliar with Bollinger Bands, this is basically the second deviation Bollinger Band, this inside blue line. And as you can see, when we zoom out, that is where the price majority of the time trades, is in between the upper and lower second deviation Bollinger Band. That's what I call the comfort zone. So sometimes what will happen with price action is, it will push up a little bit on the Bollinger Bands to try and test a level, and the Bollinger Bands will open up slightly. But they're not necessarily anticipating a trending move. Like here, for example, notice the Bollinger Bands kept flaring open past the 100 period simple. So they were anticipating that this trend was likely to keep going to the downside. And so they tried to keep up with the price to make room so that hopefully it could stay within the second deviation Bollinger Band. Now, obviously, sometimes it peaked out of it, which can happen. But for the most part, it was trying to play catch up, right? So it kept flaring open. Here, it opened up just a little bit. And for those of you who are watching this at the time, because I pointed this out, certainly the next week when we opened, they immediately started to flatten out. And that's not a good sign that the Bollinger Bands are anticipating the price to break that level. Now, obviously, that can change, but knowing that we're dealing with a strong level like the 100 period simple, right? That really big technical level that not only we as retail traders like to follow sometimes, but certainly the big boys, right? The hedge funds, they'll follow a big moving average like that as the 100. It makes for a good line in the sand. So the fact that the Bollinger Bands already started to flatten out there was another clue to us that said, hey, not really anticipating a break of this level, so we could go back down to the bottom. And then that started to happen. We started to get some back to back divergent bars. That's a sign of consolidation. And then the real test on this pullback was could we break the price support that we had back here at 3,800? And the answer was no. Once again, notice the Bollinger Bands. The Bollinger Bands were actually coming up to meet the price, flattened out. And then by the next week, they were coming back into consolidation. So that's exactly what we got, and now we're bouncing back up to test the top of the range. Another clue that we could have consolidated comes off of the monthly chart. Now, keep in mind, of course, between 4,200 and 3,800, that's still a 400-point range to be able to take trades off of, but obviously it's not a trending move like the market typically sees. As you can see back here, we're stuck in chop. So another clue is we did start to get back-to-back divergent bars on the monthly chart, as you can see here. So that can cause some consolidation. You had a consolidating signal really from last year. So back in September of last year, this started to print a consolidating signal on the compound breakout tool. Attempted a bullish signal here, but the fact that it immediately canceled out means that that's still just a consolidating signal. Another clue is momentum has been in the process of resetting, right? So when momentum resets, it either causes the price to pull back with it from bullish exhaustion or consolidation. Doesn't matter if it's bullish or bearish exhaustion, consolidation while momentum resets is always a possibility there. And that's kind of what we're in now is we got a bit of that pullback last year as we initially started to pull back off momentum. And now we're kind of hugging that zero line and we're in this consolidated range currently. So of course the big question will be, can we finally start to break to the upside and go back into the natural beast of the market, which is a bullish trend? Or do we get a little bit more selling, which I am still 50-50 about right now myself. For those of you who have been following along with me for a while, then you have probably heard me talk about this quarterly analysis that I've brought up in the past. It was a signal that I actually noticed last year. We waited to see if the signal printed, which it did at the end of the year, and it may not follow through the same way. Keep that in mind, guys. May not follow through the same way as it has in the past. This could be the first time where this signal prints and doesn't work out, which is why I cannot stress enough the only thing we can control, truly control in this market and in the market in general, not just the one we're in now, but in any market in general, is the capital risk that we put out there. That's it. That's the only thing as traders that we truly have control over. Everything else we base off of a good probability based off the technicals, the indicators, and whatever else you may like to use to trade. But the only thing we control is capital risk. So this is a signal that I've seen on the quarterly chart where every other time it's printed, it has followed through with a bit more of a bearish pullback in the past. It's a signal that printed in 2008. It's a signal that printed in the 2000s whenever we had the pullback from the dot-com bubble. And it's a signal that also printed back in the 70s whenever we had pullbacks here and pullbacks here. So every time it's printed, right, in the second quarter after the signal print, so that for us more recently, the signal printed here and it was a valid bearish signal. And so what that typically means is the second quarter after it prints usually has the highest degree of selling for whatever remains off of a bearish pullback move, which arguably is what we've started to see since last year is this pullback move. So it may not be valid. My personal line in the sand is that weekly resistance at the top end of that range at 42.60. If it starts to break that level, I'll be looking to protect capital on some of my longer term bearish trades. But otherwise, right now, I'm holding them. And they are very low risk trades with a very big profit potential. So that way, if they work out, it's going to look great for the account. But if they don't work out, it's not going to blow up the account in any way. It's very manageable on the action to take advantage of. So, unfortunately, when I've dived into this analysis a little bit more closely onto a monthly time frame, there's not a particular month that corresponds each time that says it's always the second month of the quarter that sells, right? It's not as crisp as what the quarterly signal gives us in general. And sometimes what happens when the signal prints is the first month of the quarter is kind of choppy. And that's arguably what we're seeing here, right? We've had a little bit, and you can see it on the quarterly chart. The open of the quarter versus the high, not that much difference. And that's one of the characteristics. We haven't really gotten a strong pump to the upside to where it's like, oh, clearly we've started to run higher from the open, like here, for example. So we haven't really gotten much higher, which is a good clue for people who are looking for this market to maybe turn bearish. But we still don't know yet. It could be that the quarter literally remains flat, right? Who knows? But I do have some longer term bearish trades out there in case the market does follow through on that signal maybe later in the quarter. So we'll see what happens. And like I said, if it really starts to break above 42.60, that's personally my line in the sand to start protecting some of my capital personally on those longer term bearish trade ideas. So that is what I'm seeing overall in the market. But to go back to the consolidating question, another clue, right, that we could start to chop is the fact that we were also not only at monthly exhaustion, but we have also been at quarterly exhaustion. So momentum needs to reset. Now, the quarterly chart may not reset all the way to the zero line. Sometimes it just has small pullbacks and then it keeps ripping like it wants to with the bullish trend. But as you can see here, pretty clear sign of exhaustion, especially after that run up from the COVID lows. So we're getting at least a pause in the market, if maybe not still a pullback to come in the near future. So those were just some clues that we might get chop. And just as a reminder, guys, I mentioned earlier, could be that we are stuck in a year like 2015, 2016, which if that's the case, right, it means that as much as I would love to take some trending trades, you'll either need to focus more on individual symbols, ones that are, really setting up, acting like a honey badger and going, or two, you might need to switch your strategies, right? Go inside your toolbox and look at strategies that benefit more a choppy market than a directional market, which is what most traders are used to. And so here's an example of what I'm talking about. 2015, 2016, we were at exhaustion levels with momentum. It was in the process of pulling back. But unlike what we saw last year, which was a bit more of a turn down into support levels, here we consolidated, right? We had a few little pullbacks, but the trend, the bullish trend actually never broke its pattern. It just got very close with the 10 and the 30 there. But it was still stacked up with the 10 above the 30 and both above the 100. So that still technically remains bullish. And you can see the Bollinger Bands just flattened out. Notice here as well, great example of how the price put pressure on the Bollinger Bands, but the Bollinger Bands remained flat. So they really weren't anticipating a break to the downside. You can see they ended up holding. We bounced up. And then we finally started to see the Bollinger Bands open up. We started to see momentum pick up off the zero line. We had bullish signals in the compound breakout tool. We had a squeeze, all the good clue that says, hey, maybe we're finally going to start breaking out of this chop. And you can see we did at the end of that year. We started to run a bit higher. And then, of course, that next year had some nice gains. And then so on and so forth. Um, so it could be that we're gonna be stuck in a year like that. Now, I don't want that to be the case because I am much more a trending trader. I like my trends, but you have to play what the market gives you. And when I look at all the technicals right now, even if I take out that a quarterly analysis that I kind of have and I say, okay, even though I know that analysis is out there, let's just play purely with what the chart's telling us right now. Currently, the chart on the monthly time frame at least is just pointing straight to chop. There's not much of a clue yet that says, "Hey, this is really trying to get going to the upside." Maybe if we can break a bit more above the 30 and hold that as support and in turn break weekly resistance, right? That could be a better clue. But right now, weekly resistance is still holding. This is still in consolidation. Our momentum's actually below the zero line, which adds a little bit of bearish weight, but it's basically hugging it, right? This is still consolidation. The squeeze printing is no stranger to printing and consolidation. Notice last time, right? 2015, 2016, that printed during chop. Bollinger Bands are flat. And like we talked about, the moving averages are converged. So those were all clues across different time frames that we might be stuck in chop for for currently at least the start of the year, if not maybe for the entire year itself. Hope that answers your question there, some CG. And then AD, good morning to you. Thanks for sharing the great education, of course. For some practice with unbalanced butterflies, yeah. When things were moving up, I entered a 132 SPX butterfly for today's expiration with 41.30 for the pin at a 50-cent credit in a larger account. It may screw me, but it's interesting how the P&L didn't move much even during the big downward flush a few minutes ago. Its lowest dip is only about $10. Well, let's talk about that. I'll pull up the trade here so everyone else can see what you're talking about in your end. So for those of you who are unfamiliar, credit unbalanced butterflies are a great way to play the benefit of chop and theta decay, and have a little bit of insurance, which is why I personally like these a little bit better than credit spreads. Just a pure put credit spread in this case when you can jump in. And the reason why is because it's basically the combination of a standard butterfly, which is a 1-to-1 contract amount. So here's a standard butterfly, but it adds to that one extra contract on the credit spread side of the trade, at least with how this unbalanced butterfly is set up. So that means we have one extra contract on the short strike and one extra contract on the 41.25 strike. And so you can see here right now the credit is around 35 cents. So AD got into this trade for a 50-cent credit, which means he already has a small profit depending on how this mark continues to trade, right? But it's hanging out there. So the idea is you open the trade for an overall net credit, right? That is the benefit of it. That means if it closes completely out of the money like it currently is in now, you get the net credit as your profit. The reason I like this over a standard credit spread is when you look at the max profit potential, the max profit potential is actually 550. It's the 50 cents of credit plus the 5-point width spread of the butterfly. And so your max profit potential is right at the pin of 41.30. So the idea is, at least the way I look at these trades, is I would prefer just to take the premium, right? If it remains out of the money, it's a stress-free trade. There's no issue. I can lock in that profit. But if it pulls back, as long as I place my short strike at a level that I really do not think the underlying price will break, which in this case, if, for example, AD set this because he really did not think the price was going to break the 30-period simple moving average today, which is currently at 41.39, then he's in a really good spot. He even gave himself a little bit of a buffer in case it starts to dip down a little bit. And here's 41.30, right? So it even gives him a buffer from the lows of the day with the idea that as long as this remains out of the money, I get the credit. But if it starts to pull back, as long as it doesn't break my short strike, then it's like insurance kicks in, right? And you actually get a max profit potential of 550. The risk on this trade comes into play if we really start to break below 41.30, that short strike. If it really starts to go in the money, then you have to be okay with the capital risk, which is about a 450 risk because it's the width of the spread minus the 50 cents of credit that you receive. And so he mentions that even though with the pullback that we had, it didn't quite affect the value. And that should be true, right? Because on these pullbacks that we had outside of the open this morning, you can see here, one, they're not breaking 41.40, which is a price level. So for those of you who have been listening to me on the mic the past week or so, 41.40 has been a price level on the intraday charts recently. You can see that's still holding up well this morning. So that's good news, right? That means it keeps your spread out of the money. And at the same time, the other reason why you're not seeing much of a change in this, even though we're bouncing up now, is because it's still relatively early in the day. So even though this is a same day expiration, unless we get a really strong bounce that pushes this far out of the money, because of the possibility and where the lows are of today, that maybe it pulls back into the close, right? It gets some profit taking or whatever else. You probably won't see the theta decay really start to work in your favor until closer into the close of market. And that's just how unbalanced butterflies can kind of work, is if you're chopping near them, usually you have to wait longer. Just like credit spread, you usually have to wait a bit longer for the theta decay to work in your favor. If you really start to bounce where in this case your spread goes further and further out of the money, then that causes the theta decay to act more quickly, right? Because there's less of a probability that the price will then drop all the way back down to go in the money of your strike. So that's what helps you lock in that credit for a profit a little bit more quickly. And then certainly, of course, if it does start to pull back and you're looking to play the butterfly part of this, right, that insurance, if you will, then for that to start to really work in your favor, you'll probably see that work within like the last hour, maybe hour and a half of market, because that's when the option strike values really start to go. And what I mean by that is all these out of the money strikes where they're currently at, they, especially with the chop that we've had recently, because we haven't had much volatility in general, they start to decay away, right? The value starts to decrease because there's just not as big of a chance that it will pop in that direction. And then, of course, the strikes that are in the money really do start to build in value, right? Meaning they keep their intrinsic value. So if for whatever reason going into the last hour, we're still hanging out right around 41.30, then that's when that max profit potential will start to work a bit more in your favor. So I hope that answers your question. Or just your observations, I guess, AD, about unbalanced butterflies. But overall, at least as of right now, I'd say that's a very nice trade. And if we keep stalling here, if you really wanted to, you could always add on a call unbalanced butterfly to pair with the put unbalanced butterfly. As long as it's the same spread width and within the same expiration, meaning it's a 5-point spread width here and within the same expiration, it is actually a capital positive move for your account because it treats it like an iron um, condor. Now, I would want to kind of confirm a level of resistance. Arguably, you might have thought the 10 period simple could act as resistance because of what it did on the last bar, but as you can see, we're attempting to break above it. So I would give this probably up closer to 41.60, maybe 41.65. The highs of yesterday are closer to 41.70, so keep that in mind. But if we get closer to that range and it looks like it's definitely stalling, like we'll pull back off of it if the Bollinger Bands are remaining flat, then you could always look to then add on this, and it'll actually be a capital positive move of 20 cents currently, right? It means that your total profit potential on both trades is a 70-cent credit, 570 if you hit the pin on one side or the other, and it reduces your risk from 450 down to 430. Now, obviously, I'd want a little bit more premium on that, but you get the idea there, that it's a way then you can play the consolidated range and try and look at profits on both of those trades. Because you can't lose on both sides of an unbalanced fly when one's on the call side, one's on the put side. One of those is going to end up winning. And that's why it's a capital positive move for the account if you already hold one side and add on the other. And CG, of course, always happy to help share and answer questions. And then, yeah, the 4260 weekly resistance is quite simple. It's the ATR trailing stop on the weekly chart. So that's kind of the top end of the range for my resistance. So if we really start to break and hold above that level, that's personally my line in the sand for the bearish quarterly trade idea. That's a little bit too much of a bounce away from the open of the quarter to where I'll start protecting some capital. Because one of the characteristics of this quarterly signal is that usually the high of the quarter is not that far away from the quarter's open. And that's still what we're kind of in now, right? Given the price level that we're at in comparison, we haven't really had that much of a bounce off of the open of the quarter. It's kind of still hung out relatively in the same range. But if we start to break and hold above the ATR trailing stop, which is at 4260, right? That one confirms that, okay, it looks like we could be trying to go back into a bullish trend, matches up a bit more with the lower indicators. Maybe the squeeze is starting to fire at that point. And two, that also means that we've moved a little bit higher compared to the open of the quarter to where I would at least look to protect some of my capital. I'll probably still hold one or two bearish trades out there just in case, and I'm will be 100% okay with the full risk on them. But that's what I'd be looking at for the most part there. Yeah, and there's a bit of the drop off that level again. So it's a choppy day. It's going to be a battle certainly. And then which website do I use? If you're asking me what I use, I'm not sure what it's in reference to. Um, but I use Thinkorswim for my charting, if that's what you're asking about. And of course, AD, always happy to help out. So we certainly have some time left, guys. If there are any other individual symbols you wanted to look at, let me know. I am happy to pull that up. Um, for those of you who did catch the weekly watch list that I did this week, one of the symbols that we talked about was keys. And this has had a beautiful follow through to the downside. So just wanted to point that out that if you did take this trade, don't hesitate to take the guaranteed win and maybe leave a runner on if you have multiple contracts, depending on what your trade idea was that you implemented. But this is a trade that we are looking at potentially for a bearish move to the downside. So there was that gap lower off of earnings, and then we started to hit consolidation. But I mentioned momentum, right? It looks like it's trying over, which looks a bit cleaner now because it's starting to today. We had a bearish signal though on the compound breakout tool. We had a squeeze. The only issue that I had about this trade was the price level kind of acting as support here. We kind of wanted to see a bit more of a break in that. And if we started to break it, then that was a good sign to go short. And you can see certainly into the close that day we started to break it, but you might have waited the next day for confirmation. The next day we opened right at that level and then held it as resistance. So that was a better sign to look at shorting it. And then certainly that day going into the close or today, right, with the move down, we're already starting to see that stair step lower. Bollinger Bands are being forced to flare open. So that's a good sign that they're trying to keep up with the price at this point. Plenty of room on momentum to continue that trend to the downside. Bearish signal still valid. And then you have a squeeze setting up. So the squeeze could start to fire lower as well. So not a bad place to consider runners. But like I said, if you're looking for just that quick hit and return, not a bad spot to consider taking that. And yeah, Amazon, absolutely. We can pull that up. And then for the ATRCG, it's the standard settings on Thinkorswim, the default ones that I use. The only thing I changed is how the line looks. And for those of you who are newer and do not have this spreadsheet, maybe bookmarked, I think it's a great idea to do so. Let me go pull it from my list here really quickly. But if you're signed up for the free room over at Simpler Trading, which for those of you who are on YouTube and Twitch, certainly think about signing up because we have a lot of educational material available to you and it's free, right? Hence the name free room. So it's not going to cost you anything to sign up. But within the free room archive, we have a list of educational videos to certainly check out. And I just posted it there in the alert section. And for those of you who maybe are members of the free room, but you're hanging out over at YouTube or Twitch, there is the link for this Google Doc. And basically, I'll pull it up over here. But there are a list of topics that we have talked about in the past here as traders. And I'm technically that column B for all the topics I've talked about. There are a lot of things on strategies, what's on my charts and why those CG is what I was going to point out. That goes through almost all the indicators that I currently have on my charts. There's just one, the true low, that I need to update with. But it goes over all my settings, why I like to use it. And then I also did individual symbols on the majority of those indicators. So specifically, like on 5-6, I have a video talking about the ATR trailing stop and a bit more in depth, why I like to use it, how I use it. And I believe I still go over the settings in that video as well, but I definitely go over the settings in the what's on my charts and why video, which is further up. And this is a great resource to have because you can just click on the link. And as long as you're signed into Simpler and you have access to the free room, which, everyone should because it's free, like I said, it will take you right to where that video lives on the website in the archive. So you don't have to go trying to search for it or anything like that. It brings you right to it. But that's a good educational resource to have. So certainly check that out. But let's pull up Amazon. Amazon was another one that was on my weekly watch list for this week. So we can take a quick look at that. But most of the ones on my watch list, they've either turned profitable for the week or they're still viable, right? Meaning they haven't broken the technical pattern yet. Just updating my journal so I know what we talked about. There we go. So Amazon this morning actually was a good spot to get in. Yesterday it made a bearish divergent bar but held the 10. This morning it technically followed through with a lower low but was still holding the 10 period simple as support. So when it started to bounce, that was actually potentially a good entry to jump into. Today we're making a bullish divergent bar. Bollinger Bands are starting to open up. Momentum is building up with room to move higher. We're finally starting to get a bullish signal in the compound breakout tool. So if that prints today, that's a good sign. And we have a squeeze. And this was a setup that I was looking at for basically a potential run higher into the earnings announcement. And so far, this is looking pretty good, especially if you got in at the lows of today. The only caution I had about this trade, which I mentioned on the video, is kind of this short term price resistance level here that we've been stuck in. So if we do get a pullback into the close to where it's still right around the 103.50, 75 range, then you might be a bit cautious that will still end up being in chop. But currently, right now, with how everything looks, this is starting to make a nice bullish kind of look to it to try and attempt higher. So I still like the setup. Nothing, we haven't even broken the 10 period simple. And for me, I really want to see it maintain the 30. So all of this is still valid on my technicals. The lower indicators are still valid, or if anything, are adding to the bullish sentiment, like the compound breakout tool. And you still have time into earnings to play for that potential move. For those of you who don't know, and it doesn't always happen, right? But there is a possibility where symbols like Amazon like to basically get a run up into their earnings announcement. You'll see that a few weeks prior to the announcement, or sometimes even just the week prior to the announcement, you get this bullish sentiment going into the news event. And so we had that last time on Amazon here. Short term off that low, we had a bounce up into the 100 before that held resistance and pulled back before the news there. And there are other symbols certainly that we could pull up and talk about. And it's certainly more, I will say, more of a characteristic of a bullish market than a bearish market to kind of get this strategy. But if we are going into that bullish market, right, we are seeing that effect kind of follow through. So I still like Amazon. And then upside target for Apple, I haven't talked about Apple yet, but I am happy to do so. Lincoln Park. Love the name. So let's pull up Apple now. And CG, of course, always happy to share. And Poly, STNG, absolutely. You can look at that after Apple. I haven't looked at that since we took the quick profit in the mastery. So that was another one on the watch list that ended up with a very nice quick profit. And so I was happy to take it off the table. So Apple actually also not looking bad. It too made a bearish divergent bar yesterday, followed through barely with a lower low, still above the 10, still on a bullish trend. And now we're bouncing up into a potential bullish divergent bar. So bullish divergent bars and bullish trends I like seeing because they have a better probability of getting that higher high to follow through. But we need to be cautious because if even if this prints into the close, back to back divergent bars are an overall sign of consolidation. You can see that's what happened here. That's what happened a bit here, even though it was a bullish divergent bar off support that kind of got into some choppiness. And like I said, that's exactly what happened yesterday. Yesterday, every bar on the S&P was a back-to-back divergent bar. And overall, what did we do for the day? We chopped for the most part. After the immediate open and pullback, we just chopped basically the rest of the day. So I do like seeing this on Apple, right? I don't think that looks it too has earnings coming up late May. So this could also start to experience a run into earnings. Bollinger Bands look like they're helping out with that by opening to the upside. Same thing with the compound breakout tool. That's just attempting to print a bullish signal today. So that can stay valid into tomorrow. That gives a better clue that it's going to try and run up. And there's still room on momentum. Apple doesn't have a squeeze to play off currently, but everything else about that looks pretty solid. And as for an upside target, let's see, there is some price resistance around 170. You can see that back here. That's where that gap kind of happened to the downside. And then you can see it back here. That's where we stalled in the past. So 170 might give a little bit of issues. That might be a short-term target higher. Check the weekly chart is what I meant to make sure we're not running into weekly resistance. And Dave, we can talk about Tesla too. I'll add that to the list. And then weekly chart, actually, you had the ATR trailing stop crossover from resistance to support. That can usually be a bullish, longer term trend view on the weekly chart when you have that switch. So here are some examples of that. Here, resistance turned into support on the ATR trailing stop, overall trend higher. Here, resistance turned into support, overall trend higher. Here it didn't, right? It technically turned into support, but we didn't trend to the upside. It barely broke. It was kind of a fake out move and then dropped right back down. But currently, right, especially after the last few bars, this is looking pretty good so far. There's room on momentum. Earnings might change that narrative, but for now, it's looking good. Here you can see a little bit more closely how that 170 level has acted in the past. And I would say above that, 175, 176 kind of seems to be another price level. And that's, of course, going to be a psychological level. So that'd be my two next short term targets. But from a momentum perspective, there's still a lot of room that this could try and continue higher just based on if this is going to go to the top of the range for exhaustion or not. So hope that helps you out. But that's what at least I'm seeing on my charts and technicals currently. Let me pull that off. And then ST and G, let's pull that up. So, like I just mentioned, STNG was another one that was on my watch list for this week that we put on in the Profit Recycling Mastery. And that allowed for a very nice quick win. So it is, it's pulling back today. The squeeze is just starting to fire. Momentum's crossing above the zero line. So both of those add strength that we still might get a bullish run into earnings. The only thing, Polly, I'm not a fan of on this was that ATR trailing stop. And that's what I mentioned yesterday, if you remember, into the close, is I love that we broke above it But just like we talked about on, what was it, Apple a second ago, sometimes when you barely break the ATR trailing stop, but it stalls, it's like a fake out move where that price level is still basically trying to hold resistance. And so in this case, that's a little bit what it's looking like. Now, we are getting a pullback. It's not much of a pullback if, we're being quite honest. And part of that is probably because of the third deviation Bollinger Band snap. When the price exceeds the third deviation Bollinger Band, which is this outside blue line, it can cause a case of FOMO. That's part of the reason, actually, when we jumped into it the other day, we didn't mind doing so because it had a valid squeeze and it had that third deviation Bollinger Band snap. You can see the next day it caused a nice higher high. But the other characteristic of this is the next day or the next few trading days, it basically chops within this range. It doesn't necessarily give it up, but it chops. And so that's kind of what this is looking like right now. Personally, I wouldn't mind if it gave it up a little bit more if we're looking for a re-entry, so that way we could get in closer to the moving averages. So what I would be watching for on this poly into the close is, do we continue to pull back, which is what it's actually starting to look like as I speak? Or do we get a bit of a bounce into the close and maybe this forms a bullish divergent bar? If it forms a bullish divergent bar, I'd be okay basically jumping into that today and maybe giving yourself time to play at least for a move back up into 62, if not higher, with the trend. But if it looks like this into the close, I'd probably give it one more day. And I might miss a little bit of the move, but I'd want to give it one more day because that way, if it does pull back into support, one, I can confirm support's going to hold, right? So that way I can jump into a bullish trade. And two, if it does hold and everything still looks valid, then I'm jumping in at a much better price level down here around 57, right? Compared to where it's trading at now at 59. And we know just a dollar or two move on this on the option chain can allow for a very quick profit depending on your strike and strategy, given how it typically moves in general. So I do like your thought process there, but I'd probably wait a little bit more into the close and say, okay, does it pull back more? And if so, give it one more day just to prove support wants to hold. Or if it bounces into a bullish divergent bar, then that might already be our clue of, okay, let's, try again for 62 or higher. Of course. Absolutely, guys. Of course. And then Tesla. Let's talk about that. And Lincoln Park, not a problem. Not at all. Let's go to Tesla. So Tesla has earnings this week. For those of you who don't know, right? We have oh, let me type that in properly. Here we go. So we had Netflix earnings. That caused, certainly it looked a lot worse yesterday after market, but it just basically bounced down towards daily support, but it certainly wasn't a positive earnings reaction. So the question, of course, is, will another big name like Tesla lead to a positive or negative reaction? And we have earnings today into market close. After market close is the announcement. And so a few things to note. The first one I would say is we do have a bullish divergent bar. And the first quarter, because of all the selling that we had last year, notice that Tesla, for example, got a run up into earnings. So you see how that narrative can still work. But it printed a bullish divergent bar last year into the earnings announcement that was valid. And for those of you in the master, you probably remember this, but we found that last quarter in particular, when we printed a bullish divergent bar that was valid into the announcement, it wasn't uncommon for the price to get a bullish reaction from earnings. And Tesla is one of those where it did, right? It had a nice gap up, follow through with a higher high, and then it continued with the trend. I don't know if that's necessarily the case for this earnings season or not, because the unique thing about last earnings season was a lot of symbols were coming off of strong selling into the close of last year. And so any sort of, positive news, quote unquote, from the announcement or any sort of like things are in line, right? We're not falling apart. If that was said on the announcement, then usually because of all the selling that we had last year, it caused a positive reaction from the market to get that pop up. So we've already kind of had that, right? I don't know if that will follow through this year. But Tesla, I will say, going back through things, right? It can be a bit more of a volatile announcement. So last earnings was definitely volatile here. Maybe not as volatile. We gapped down a little bit, but we basically held price support and then stalled, right? So that was a bit more of a consolidating style trade that you would have considered. On this earnings back here, we had a bounce up and then trended a little bit higher before a pullback. And then off this earnings, we gapped up, but then immediately pulled back. So it's kind of a mixed bag, right? Some earnings lead to a gap and then just get pure consolidation. Some lead to a gap and then they keep going. So the so if that's the case, there are really two different ways to trade this, depending on what your outlook is. If your outlook is Tesla's going to be a non-event, right? Earnings isn't really going to affect what the price is doing right now, then usually strategy wise, I would lean towards an iron fly, something to take advantage of the chop and of the spike in the option premiums, along with the theta decay that will happen after the announcement, right? Because all these premiums right now are spiked due to the uncertainty of the news. And if the news is a non event, then all this option premium is going to suck back out of the option strikes for this specifically this week's expiration. So an iron fly is usually a good strategy to go with if what you think is going to happen is basically chop. So right now, you might place this a little bit closer into the close just so you have a better level at into the close of where the price is trading before the news. But let's say this is where we're trading at into the close. We're right in between the 180, 182.50 strike. I'm going to go with the 180 strike because there's a bit more open interest here currently on both sides. So I sell to open both the call and put strike. And then the anticipated range is about 12 points. So let's go out basically 12 points, right? 1250. So the 167.50 on the put side, and we'll go up 1250 to the 192.50 on the call side, and we'll create an iron fly. And the idea is that we think that Tesla will stay within a 1250 point range up or down, that it will basically stay within the anticipated move. And so right now we're getting about an 890 credit on that trade idea, but it is a 360 risk. So what does that mean? Well, it means that if we do basically stay flat and hang out between our moving averages and our ATR trailing stop like we've done the past week and a half, then theta decay, like I mentioned, will come out of this trade. And that 890 of premium will drop down. And that difference between the premium we got versus what that price will look like the next day will allow for an overall profit. However, on any earnings trade, in particular, especially when it's short dated like this and you're holding it through the announcement, you have to be okay with the risk that you put out there, meaning you have to be okay losing 100% of this capital because anything can happen around earnings, right? Elon could come out and say, I'm selling the company or I'm doing this or, who knows, right? Our outlook is different or, oh, we're moving manufacturing. Doesn't matter, right? But I mean, obviously, it does slightly matter if you hold shares and you're invested in the company like that. But from a trading perspective like this, it really doesn't matter what happens on the news. What matters is the market reaction to that news event. How does the market respond? And if the market responds in a more volatile way, then this trade is not going to work out, and you need to accept and be okay losing 360 of capital. And if that's a bit rich, but you think that Tesla is going to be a non-event, then you might consider dropping the strikes in, right? Narrowing them down so that way you still get a decent premium, but it just reduces your capital risk. The downside to doing that is you're not giving as much room for Tesla to be able to trade and still, have a nice profit potential basically, right? It means that if we break just a little bit past 170, for example, well, then this trade may not work out. You might have to take the 230 of risk, where if you went with the slightly higher strike, there's still a possibility for break even or a profit if it stayed within your wing, right? So pros and cons. But that's the first trade idea to consider. The second one is if you do think it's going to be a volatile move. So if you think it's going to be like last time, where we pop up and then continue to trend, then my strategy is I usually look at something on both sides, right? Because I have no idea which way that volatility could move. I don't know if it's going to be a positive reaction or a negative reaction. The point of this trade is that I just think it will be a volatile reaction, right? That I do think that we'll get some sort of gap and run move. And if that's the case, the way I usually go about it is I still go out basically the 12 points in value, but then I put a directional trade around that. And usually my go-to is a debit broken wing butterfly. And that is very much like a standard butterfly, but it's where the debit spread side of the butterfly is just a bit wider than the credit spread. And the benefit of that is if it goes completely in the money, and this is not, sorry guys, let's do this a bit properly. There we go. So this is a 2.5 width spread. So you can see that debit spread is just a bit wider than the credit spread, and it's about a 95-cent cost basis. So I can already tell that's a little rich for what I'd look at. Let's bring the strikes down just a tiny bit. So they're pricing up the call side, I would say right now. We'll check out the put side. But let's say we go with this one. So it's the 190, 195, 197.50. Right now it's about an 80-cent cost basis. So that's a 420 profit potential if you get the pin on Friday, right around 195. But if it goes completely in the money, it still actually allows for a profit. And that is the difference of spread width. So 5 minus 2.5 is 2.5. So that would be the value of the broken wing butterfly if it closed at 200 on Friday. And then, of course, we have to take into consideration our cost basis of 80 cents, which still leaves you a profit of 170. So once again, not a bad risk versus reward. But remember, the idea is we're playing off volatility. We have no way of knowing which way that volatility is going to go unless you have the insider scoop. you don't know if it's going to be a positive or negative reaction. So we also want to look at doing the same thing on the put side. So roughly 12 points lower would be around 167.50, but let's go just slightly further than that. So let's do the 170. So that way we encompass the range 170, 165, 162.50. And that's about a 61-cent cost basis. So like I said, they're kind of pricing in the call side to be a little bit more expensive than the put. And I do apologize, my sound's breaking out a little bit, but almost done with the session here, so I'll just finish up and then we'll shut down. But right now it's about a 61-cent cost basis. So the idea is you take both butterflies combined, 80 plus 60 is $1.40 of total risk. And now once again, if the price remains flat, if it's a non-event tomorrow, you will lose on this trade. So you have to be okay with the full $1.40 of risk. But if we do in fact get a volatile move of at least 12 points or greater, so still within the anticipated range or more, if we get that volatile move, then you have a max profit potential of 5 minus $1.40, so 360 max profit potential on one pin or the other. And if it goes completely in the money on one side or the other, you still have a profit potential of $1.10. So not a bad risk versus reward either way. Gives you that flexibility and that forgiveness factor that if it's a really big move, bigger than you're anticipating, the debit broken wing butterfly still allows for that profit potential. And then this way you don't care if the move's up or down. As long as it's a bigger move, you can take a profit on one side or the other. But that is my time today, guys. So I apologize. I sound like C3PO going into the close. There it is. It sounds a bit better now on the sound breaking up. But that is my time today, guys. So thank you so much. I hope you guys have a great rest of your trading day. Really quick, SK is asking, how about a broken wing butterfly for April 28th? What are the pros and cons? The pro is that you give yourself more time to maybe allow for a trending move. The con is if you get that immediate move to happen in your favor, this will give you the better profit potential more quickly than you will see for the April 28th expiration. So hope that helps you out. But thank you guys. Have a great rest of your trading day. As always, may the trade be with you, my fellow Jedis. And I look forward to talking to y'all next time. Bye, guys.